Let's pick up on that financial results from Capitec today. First half numbers out just a few hours ago. Simon Fillmore is the Chief Executive of Independent Securities, and he joins us just to give us some insights from his side. Simon, before we went on air, it sounded to me as though you felt these weren't too bad, these numbers.
Yes, I think they were a very decent set of numbers given the prevailing economic circumstances. Certainly they could have fared a lot worse, as we've seen with some of their competitors. But I think, once all said and done, a very satisfactory set of results from the business.
All right. I'm going to differ with you, and I'm going to ask you to put me right. Value of loans advanced down 26%, so business is shrinking. Provision for doubtful debts, in other words, what they have to write up 70%. So the business they've got is getting worse. How can you think these are good numbers?
I think if one just needs to understand a little bit about the business model itself and realize that at times like this, there are going to be occasions where they need to write off more debts, and I think rather than a single snapshot, it's about the processes in the business. And I think essentially the risk in these types of businesses comes in firstly in terms of their funding, the credit rules that the business applies, and then lastly on the provisioning. And I think in terms of the provisioning, we've seen that Capitec are quite aggressive in that regard. If they have debt that's outstanding for longer than 90 days, they write off the full balance of that loan. So as long as those as long as those aspects are in place, then I think the integrity of the business remains sound. But I think it's just to constantly apply that formula and realize that as the business moves through different cycles, that you are going to see results like this, where the loan impairments does increase quite significantly.
This is a stock that is virtually unchanged in the past year. It's down slightly. Able is down by more than 50%. If you were a trader, surely at this point in time, and looking at these numbers, you can interpret them different ways, I guess. You're drinking the Kool-Aid from Capitec, I'm not so sure. But would you not then be thinking a switch from, if you do like the sector, from Capitec to Able would be in order?
Yeah, it's a good question, but I think generally we seem to see that in companies themselves, the momentum does demonstrate itself. So that if a company is doing well, it's got a particular business model that's working or strategies working, that continues to carry on working forward. And I think maybe the same applies in this instance. And I think there's a very large differentiating factor between these two businesses, and that relates to the transactional side of the business. And we've seen over the last 2 years that the transactional side has become a significant differentiator for Capitec, and it's so much so now that it is about 33% of their business. So it's a significantly different business to African Bank. And I think you mentioned that the share has gone sideways for some time, but I think we've seen a lot of the risk taken out of the share, because if we went back 18 months ago or so, the PE of the company was closer to 20 times, where at the moment the forward PE is probably around 11 times. I think from an investment perspective, just the derating of the PE over the last 18 months has taken some risk off the table in terms of investors.
Simon Fillmore is with Independent Securities. The thing that jumps out at me is 4.6 billion in interest income. So in other words, on the loans that Capitec had, they got interest of 4.6 billion. They wrote off bad debts, almost 2 billion against that. You've got to have big capital and big cojones to be working in that kind of business. And certainly, I suppose that's exactly what they have. Well,